The Bank of Thailand, or BOT, has lowered the economic growth forecast for the country to 1.5% as escalating tensions in the Middle East weigh on business costs and tourism. Central bank officials stated that inflation is expected to rise to 2.9% due to elevated oil prices caused by the conflict. While the economy was previously expected to expand by 2.4% in 2025, policymakers now observe a broader slowdown extending into 2026 and 2027. More than 80% of businesses are facing sharp increases in operating costs, while tourist arrivals are forecast to decline to 33 million visitors. Despite weaker domestic conditions, exports are expected to grow by 8.1%, supported largely by demand for technology-related products. Investment growth is projected to slow to 3% this year before easing further to 2.6% next year, as businesses remain cautious amid global uncertainty. The central bank clarified that the likelihood of stagflation in Thailand remains limited, even as economic activity softens. Officials identified three major risks facing the economy, including the ongoing international conflict, United States monetary policy, and the effectiveness of government stimulus measures. The bank estimated that the proposed 400 billion baht emergency loan program could increase economic growth by 0.6% in 2026. Compared with the baseline scenario. However, this impact is expected to moderate to 0.4% the following year. The central bank urged the government to spend the funds carefully by prioritizing support for small and medium-sized enterprises and people directly affected by the slowdown. Authorities recommended keeping a portion of the budget in reserve for future emergencies to ensure long-term fiscal stability.